Mortgage spreads are almost back to normal, which means the 10-year treasury will not have to drop below 4% to see interest rates, mortgage interest rates in particular, closer to that 6% range. Does that mean that we are going to see lower mortgage rates right here in San Diego? Well, let's dive into that right now. So what does that all mean? So in a week marked by discussions of the potential firing of Federal Chair Powell, in inflation data, mortgage rates remained relatively calm thanks to improvements in mortgage spreads. Mortgage spreads have improved significantly since 2023, leaving us just 0.49% from normal levels based on the data that HousingWire is using right here. This means that we can achieve near 6% mortgage rates without the 10-year dropping below 4%, provided spreads continue to improve. So if this trend continues and we do see the 10-year treasury coming down and we see the spreads between the 10-year treasury and mortgage rates improving, then we could ultimately see lower mortgage rates here in San Diego. I'll give you an example at the end here of what that would look like from rates right now to what rates could potentially be in the future and what those payments would look like on a house right here in San Diego. Over the past few years, Logan Motoshami, who wrote this article here, he's seen housing demand improve as mortgage rates trended from that mid to high sixes towards that 6% range. So more people out there, more purchasing power, more buyers in the market. This is something we haven't been able to get yet in 2025 in terms of duration. Maybe it's hit a few times, but we haven't seen it continue for a while. So just for a little context between the 30-year mortgage rate and the 10-year treasury yield and how that affects mortgage rates right here in San Diego, you can see back in the 70s and 80s, we were well above this 2.5 line. Now, long-term average is probably right in, according to CME Group, was right around 1.7 to 1.8 is where we usually see that. So if 10-year treasury was at, let's say, 4%, and we're going with that long-term average, mortgage rates would be 5.7 to 5.8. Obviously, it hasn't been that because I'll show you what the 10-year treasury is right now and where mortgage rates are right now. From about the late 80s all the way through until the great financial crisis right here, 2008, when it did jump up. For that whole time being, it was under this 2.5 difference. Right now, we are just at that mark, meaning there is a difference between the 10-year treasury. Let's just bring that up right now. So the 10-year treasury right now is 4.358. Now, how is that affecting the mortgage rates right here? Well, let's check it out from Mortgage News Daily here. Here we have it both charted. We have the 10-year treasury yield. This is from July 18, so these numbers are going to be a little bit different. But then we have the 30-year fixed rate mortgage. Now, when we go over the mortgage rates and where they are right now, this is just ballpark. This is for a specific credit, a specific borrower, specific loan amount. When you go and talk with a lender and you go over your specific situation, you're going to come up with the number you're comfortable with as far as your monthly payment. But they have different mortgage rates for different borrowers. So if you have better credit, you're going to obviously get a little bit better rate. There's difference between jumbo loans. If you're getting VA loans, those are going to be different rates. So all these are different, but the trends are usually going to be the same as we see with the 10-year treasury. So take all the mortgage rates with a grain of salt. When you actually go talk to a lender and start that conversation, your numbers are going to be different, but this will give you a good ballpark and a good starting point on what's going on. So on the left, we have the yield for the 10-year treasury. On the right, we have the mortgage rates, and we can see where we are as of July 18th. So let's just go to Friday right there and see what the spread was. So mortgage rates were sitting at 6.82%. And yields were sitting about 4.47%. So we had a 2.35% yield. Now, if that gets closer to that range, that 1.7 to 1.8, the long-term average, I'll show you how they come up with all that as well and what's going into those numbers. But it would be closer to probably a 6% interest rate, low sixes, somewhere in there. And here is a 30-year treasury spread. So the treasury from the 30-year mortgage rate to the 10-year treasury and where we have been since 2008. See the jump up that we did have during the great financial crisis that we did see in that same chart before. Here is where we were since 2010 going all the way until 2020. So we were right at or slightly under that 2% range. Once the pandemic hit, it jumped up. We saw a sharp drop off, and then we have trended up, kind of going up to here. But you can see it has been going down over these past few months here. So right now the spread looking right here in June and July was about 2.41. And now we can get into what determines the mortgage rates on a 30-year mortgage. It's kind of boring, but to basically break it down here, you have the 10-year treasury note, you have primary secondary spread, and then you have the secondary spread. So to put it in simple terms, what moves the spread? And these are important because if you keep eyeing these over these next few months, and you see that these are getting better or there's changes in these, they are going to affect the 10-year treasury, which in turn is going to affect mortgage rates. So if you're thinking about buying and you're like, what's going on? This is a lot to take in, but these are some things you keep eye on. The 30-year mortgage rate versus 10-year treasury yield. Why is there a difference? First off, there's a risk premium. Obviously, mortgages equal more risk because you got defaults, you have early payoffs, and investors demand a higher rate for more risks. So you get a wider spread. The more risk in the market, the wider the spreads are. As we've seen over these past few years, there's been a little bit more risk in the markets. Hence, we've had a bigger spread than usual. Then supply and demand for MBS or mortgage-backed securities. So a low demand for mortgage-backed securities, rates are going to rise. When you have strong demand, i.e. the Fed is buying mortgage-backed securities, the spread will narrow. Third factor is lenders' costs and margins. So you need costs to originate, service, and hedge mortgages. So higher costs equals higher mortgage rates equal a wider spread. And also market volatility, which is one of the big ones that we've seen recently. Treasuries are a safe haven. So the 10-year treasury, basically you're putting your money in there risk-free. That's where it's going to sit. Yields will fall faster in uncertainty. Mortgage rates move slower equals the spread widening. So the bottom line is the spread reflects investor risk appetite, market conditions, and mortgage bond demand, not just treasury yields. So let's take this into account here. Let's act like you're an actual buyer in the market. What's the difference between your monthly payment if mortgage rates did drop from where they are today to closer to that 6%. So we're just gonna go right at 6% just to give you a good comparison of what your monthly payment might look like. And like I said, all these numbers are gonna be different for your specific situation. So if you guys are thinking about making a move and you wanna start that conversation, all of our contact info is right below. Just hit us up. We can start that conversation, hook you up with a lender. We have a great lender right here in San Diego, and he could run you through just a brief conversation of your situation and kind of see what actually would potentially work for you. So let's take a house price of $950,000. We're gonna put it 10% down. Now, usually you're gonna have PMI or private mortgage insurance down here. We're gonna keep that out just to keep it simple. The numbers are gonna be relatively the same. And let's go with the mortgage rates from today, which is 6.78. So let's go 6.78 into here. We're gonna go with a credit score. That's gonna affect your rate. It doesn't really matter for this. We're gonna go property tax, about $800 a month. Property taxes here in San Diego are 1% of the assessed value plus a few other items. So this one, $950,000 house, your base taxes is going to be $9,500 plus, like I said, depending on where you're living. Are there Melloroos? Are there anything else? There could be potential on there. And homeowners insurance, we're just doing $200 a month, so $2,400 a year. Once again, this could vary depending on if you're in a high fire zone, if you are in a condo, if you are in a single family home, all those factors will come in. Like I said, we're gonna keep PMI off this. We're gonna say it's not in a HOA. And you can see your monthly payment, this is with everything, is going to be $6,563. All right, now what if rates did fall? What if you're waiting till they get down to 6%? Let's see how much you're actually saving per month. If we put in a 6% range, we're gonna update that. Your monthly payment is gonna be $6,126. So let's do 6,563 minus 6,126 equals a savings of about $437 per month. Now, if we go yearly, you're gonna be looking about $5,244 per year. Now, long-term, yes, you're gonna have interest on all this, but just wanted to show you an example of what it looks like between a 6.78% rate and a 6% rate that we did see right here. So are we going to see interest rates drop right here in San Diego? Only time will tell. We don't predict interest rates here in San Diego, but if we do continue the trend where we see the spread between the 10 and the 30-year shrinking and the 10-year drops a little bit, then that will in turn cause interest rates to go down. But who knows what's going to happen with the Fed? Who knows what's going to happen with the markets? Who knows what's going to happen with risk? Is the Federal Reserve going to start buying more mortgage-backed securities? Are they going to be printing money? Just a lot of different factors. So anytime you're making this decision, really run your numbers, make sure you're comfortable with that for the life of the loan, because you just want to make sure that you're not taking risk on one of your biggest purchases that you're going to be making. So, and if you are thinking about waiting, you want to wait till mortgage rates drop, you want to wait till there's a little bit more certainty out there, just imagine there is going to be more people just like you out there. As we see mortgage rates drop, we see more buyers going into the market. So right now we're looking at the purchase index versus the 30-year fixed. What the 30-year fixed is this line going up here, and the purchase index is how many loans are being generated out there. So you can see right in here, I'm just going to show you a few places. So January 30th, 2023, we saw rates dip down to 6.09%. You can see when rates were at 7%, close to that 7% range, there was obviously less purchase applications out there. As they came down to that 6% range, purchase applications went up. As we jumped up again to 7.79% in October and November of 2023, you can see purchase applications, the purchase index went down. And we can see that pattern going down. The rates come down. You can see this jump going down here. Surprised it didn't jump more here. There was a little bit of a spike. This is in September 2024, but you can see it did spike a little bit. And as rates have kind of mellowed out, so if we're not seeing those big spikes where we're seeing up and down and up and down, when we're seeing a little bit more cohesiveness in the market, we're seeing a little bit more steadiness in the market, the purchase index has continued to rise. So if this did drop down to the 6% range, you're likely going to see a spike. That spike is showing you that there are more buyers in the market. And so if you guys want to start that conversation, like I said, I'm Chris Erickson. We got a real estate crew right here in San Diego. We can definitely hook you up with our lender, go over all these numbers, get some insight into where things have been going. Amir has actually been on this channel, so you go back and watch a few old videos and get a little intel from him, but we'll definitely have him on in the future as well to break all this down and make sure you are in the know right here in the San Diego real estate market.